Hello, everyone, and thank you for joining us today. I am pleased to introduce our speaker for this session, Nancy Tengler, the Chief Investment Officer for Laffer Tengler Investments, LTI, and the Senior Female Officer of the firm. Ms. Tengler has been committed to advocate for women's financial education and empowerment over 4 decades, and as the leader of LTI's Women and Wealth program, she utilizes current research and topics from her book, The Woman's Guide to Successful Investing, with the goal to guide women to take charge of their finances. Now, our viewers, please note that you can put your questions in the live chat box, and time permitting at the end, I will go ahead and share your questions with Ms. Tengler where she would be able to answer them. Thank you so much, Nancy, and the floor is all yours.
Thank you, Aya. Thanks everyone for joining. I'm going to share my screen, which, I think you have to unshare your screen. Oh, perfect. Which is no small feat for me because as I used to tell my students when I taught college, my generation invented technology. We don't really need to know how to use it. Here we go. All right. So listen, this is a great day to be having this discussion about discipline. Most investors last year, if you just showed up for work, you did pretty well in the markets. Those days we think are behind us, at least for the near term. It's going to matter what you own, and it's going to matter how much you pay for your investments. And so we want to talk a little bit about that today. I really want to thank the Money Show for encouraging all of us to dig in and learn a little bit more. This is a business where you never stop learning, as I am well versed. So let's see if we can figure out how to get this thing advanced because it's not advancing. Oh, here we go. So what would a presentation be without shameless self-promotion? I just wanted to share with you that we received our 5-star Morningstar rating on our equity income fund, which is really the discipline that I'm going to be discussing in greater detail today. But first, let's define some terms. So investing, unlike trading, is a marathon. It's not a sprint. For those of you who watch financial news, and I'm on financial news, you would probably tend to think that without any other information that trading is a sprint, and it's not. I mean, that investing is a sprint. That's trading. There's a place for it if you're adept. But one of the things that I think and I think the Reddit crowd is learning this now, and the Robinhood crowd, basing investment decisions on headlines is for adept traders, for the algos that can trade at warp speed and are unconcerned about the taxable implications of trading. Most of us don't really want to have to pay capital gains if we don't have to. And a strategy that maybe takes a longer term focus is more in line with what we should be seeking and aspiring to. Investors, to paraphrase Warren Buffett, should not own a stock for 10 minutes. They wouldn't be willing to own for 10 years. I agree with him completely on this. I'm not a Buffett devotee. I love his work. I love a lot of investors' work, but I do think that he lends a certain level of folksiness to his conversations around the market that most of us can relate to. I view the world as an investor and not a trader. So from that standpoint, that's what we're going to be talking about today. So this chart may be a little bit difficult for you to see, but what I wanted to show you is volume at the bottom in the bar charts and price movement in the top in the line chart. And what you can see if you look closely is that volume tends to spike in this mystery chart when price goes up. So what that tells us is that investors are chasing higher prices for the most part. And that's one of the things I want to guard against, particularly today, because the flip side is also true often. And that's why Peter Lynch once said, don't let the markets scare you out of stocks. And so we'll get into that in a moment. This particular chart is Coinbase. So it's kind of a referendum on Bitcoin. And you can see that when the price of Coinbase goes up, investors are much more interested in owning it, which is exactly when you would prefer to be selling it. Having any discipline, in my experience, is better than having no discipline at all. So left to us, our own devices, many of us will zig when we should be zagging. Discipline keeps us from chasing winners or doubling down on losers. The bad news, it can feel like watching paint dry. I was once asked by an institutional investor if what we did was so good, why didn't anyone else do it? And I informed him that it is because it's like watching paint dry, and you can't charge 2 and 10 like the hedge funds do to watch paint dry. I'll also point out that last year, the average hedge fund manager was up 11.5% in a 28% S&P environment. So there's a lot to be said for not engaging in trading and unnecessary transactions. It ultimately detracts from the total return. I had mentioned earlier my book, The Women's Guide to Successful Investing. One of the studies I cite in there is the Barber and Odine study entitled Boys Will Be Boys, Gender and Something About Investing. And what it showed was women's returns over time. This happened to be focused on the question of, do women make good investors? Women's return in this live 10-year study were one full percentage point annually above their male counterparts. And it was something like 3% if the male competitor was single, because men tend to be more competitive and they tend to trade more, and trading ultimately detracts from total return, especially on an after-tax basis. So we're in a volatile environment. When I wrote this, I didn't know we were going to be in a volatile environment, but I thought we would be. And so even though we can't spell long at Laffer Tengler, we spell it Ling. It's important to understand why volatility is good for long-term investors. And this again is a quote from Warren Buffett. The true investor welcomes volatility. A wildly fluctuating market that irrationally lowers prices will periodically be attached to solid businesses. And that's exactly what I think we've seen over the last couple of weeks. Look, I think we've been due for a correction. I've been talking about one for a year. I'm surprised the market has been surprised by any of what we've experienced. We knew that we hit peak earnings growth in Q2. We knew that we hit peak GDP growth in Q2. We knew that we hit peak monetary easing in Q3. And I just wrote a paper in December on the case for peak inflation in Q4. So all of this was known. We knew the Fed was going to need to raise rates. We think they should have done it a long time ago. But regardless, the volatility that we're experiencing is likely an opportunity unless you believe that the Fed is going to make a policy mistake so big that they're going to push the economy into a recession. So I want to give you a real live laboratory example. I'm not going to speak for very long. I want to open this up to your questions, and I hope you're enjoying my backdrop. I'm at the White House. Actually, I'm in Dr. Laffer's studio, and he has the White House and Nashville, so I chose the White House as my backdrop. In April of 2007, I bought Starbucks because it was attractive based on my valuation discipline, which we're going to talk about in a moment. The stock had come down from a recent high of $40 to $30. Howard Schultz had left the company. They had overexpanded, and Wall Street wasn't enamored of the story anymore. In December, after I bought the stock, Howard Schultz came back to the company and the stock rallied. And of course, like most investors, I thought I was super clever until 2008. And I think we all know what happened in 2008 and 2009 when the bottom fell out under stocks. By the time the bear market was all said and done, the stock bottomed under $10 a share. Despite the rout in the stock performance or stock price, the fundamental reasons I bought Starbucks remained intact. So this was a company that, like many of the companies that I buy, is a franchise leader, had pricing power, generated a significant amount of free cash flow, and grew the dividend. All the kinds of companies that you would want to be interested in owning in this environment. I held on. And since that time, I just included a Bloomberg chart, and it was through January 12th when I actually put these slides together. The stock is up 706% on a cumulative basis versus 350% for the S&P 500. When you buy great companies, inevitably things go wrong. And the question you have to decide as an investor is it still the same company that I bought, and can I afford to hold on? When you're collecting a dividend, it's a little bit easier of a discussion with yourself than it is without. But on an annualized basis, if you can get 15.214% in any investment over that very long time horizon that I'm examining here, you want to take the opportunity to accumulate those shares. And it's always better if you're getting them on sale, as we are right now. So to paraphrase Peter Lynch, don't let the market scare you out. If you own great companies, sell-offs are often an opportunity to add more. But sometimes, just sometimes, there's a seismic secular shift that management misunderstood. And I've chosen for that example, IBM. Now, you might argue that IBM has finally figured it out and it may be the time to own IBM. That may well be true. But this was a stock that I bought in 1988 for my son when he was born. And my decision to do so was based on the fact that it was an industry leader and a dominant player. Obviously, I've only calculated performance over the last 20 years, but you can see that IBM has been a serial underperformer because the previous management and the management before that and the management before that missed the pivot to the cloud. And that's mostly on Ramadi's, on her lap. She was trying to financial engineer the company. We haven't seen revenue growth. We finally saw some revenue growth this quarter, but this is a company that has dramatically underperformed for a very long period of time. It was an industry leader, something changed, and you can go back in history and find plenty of them, Polaroid, Xerox. I don't know, we can deal with those in the Q&A, but IBM is clearly one that has missed it. The question now is, will they be able to put it back together? I'm going to sit on the sidelines until I see more evidence. But this is an example of a blue chip company that lost their way. So I'm going to introduce two disciplines to you, and then I'm going to open to questions. This is a discipline that I use and have used since the mid-1980s. When Aya said I'd been in the industry for 4 decades, I almost choked, but she's absolutely right. And by the way, I think that's super important when you're in an environment like this. Many of the portfolio managers that you see talking on TV or you might listen to in other forums have never invested through a rising interest rate environment, nor through rising inflationary environment. And so this is a time when experience is helpful, but the basic tenets of investing still remain intact. And that's what I want to talk to you about. So the green line that is graphed is relative yield. So we're interested in buying companies whose relative yields based on their own history, this is 20 years of history for this particular stock, based on their own history, have a yield above where they've traded historically and above the market. So once we get this graph in place, we set the buy range 2 standard deviations away from the mean. You can do whatever you like. You can eyeball it and get a rough idea of whether or not the stock's cheap. But typically when the relative yield is rising, the relative price, which is the faded yellow line, is down. And you can see that there is an inverse correlation between the two. So relative yield goes up, the price goes down, it's like a bond. But what we get also from this information is not only is the stock cheap, but from the dividend and the company's dividend paying culture, we get an indication of what management thinks long-term sustainable earnings power is. Companies are loath to raise their dividends if they don't think they can sustain them. And you can look at the most cyclical group on the planet, oil companies, and what you'll see is that there are times historically when they have held the dividend constant, but they do not cut their dividends because they know they'll lose their constituency. And so they set it based on what they think they can sustain over a long period of time, and that goes into the earnings calculation. Wall Street, the reason we don't use earnings is because Wall Street analysts are notoriously wrong. Otherwise, 2/3 of companies would not beat expectations every quarter effectively. So what we want is an inside look, and relative yield gives us that. And then in addition to that, it gives us a really reliable way to tell when stocks are cheap and when they're expensive. Now, in our work on an institutional level, we don't just automatically buy a stock when it enters the buy range. We have a proprietary research model, 12 factors that we examine, and the company has to pass those 12 factors. But that's what we do. You don't have to do that. At turning points, sometimes you can get sucked into value traps, and those are what we're trying to avoid. So our 12-factor analysis keeps us out of trouble for the most part. But I think what you should note is that when the stock enters the sell range, we will begin to sell, and you probably should too. So in this particular stock will probably surprise you. This is Apple. There was a time in 2014, 2013, when we were buying the stock that Apple sold at a yield of almost 3%, just under. It was above the 10-year, back when the 10-year had a little meat to it. And it was a stock that everyone hated. They loved to hate Apple after Steve Jobs left. And so what we're showing you here is the relative yield and over time. So let's go to the next chart. The other metric we use, so in the 90s, this didn't really help us very much because we were unable to own technology stocks. And that was great news in 2000, late 99, 2000. But we really want to be able to own technology. And we did in that period of time as well, because we understand the power of technology, not just to economic growth, but improving productivity. So this metric that we developed, we said, okay, well, what's the next most reliable metric? And we determined it was sales. You can manipulate earnings. You can drive a truck through GAAP and pro forma earnings. Sales, hard to manipulate, and they're just a fact. There are a few people that have attempted to manipulate sales, and I think they're all still in jail. So what we graph here is in the green line is the relative price to sales for this particular company. So again, relative to its own history and relative to the S&P 500. And what you'll see is that we are more interested in buying a stock when it has a low relative price to sales ratio, and we're interested in selling it when it has a high relative price to sales ratio. This particular stock is in our sell range, and you can see the correlation is pretty powerful to price. When relative price to sales ratio rises, the price of the stock is usually rising as well. This too is a chart of Apple over the same period of time. So what I've found over time is that if you have a discipline, it's not always right, but investing, mind you, is about being mostly right. Most of us only remember what we did wrong, but if you're mostly right, you will generate excess total return above the S&P 500 over time, certainly above your goals. In my book, I talk about a study, an interview that I'd given. I was trying to find something on the internet late one night when I was writing the book. It was in April of 2013, and I was looking for something on asset allocation, and I found an interview that I had given, not to the Wall Street Journal, but to the Wall Street Transcript 10 years prior. So almost to the day, April of 2003, totally forgot about it, 5 stocks. And I thought this would be a perfect example. And I calculated the performance for all 5 stocks. I don't have the numbers committed to memory, but 2 of the stocks dramatically outperformed the market, 2 underperformed the market, and 1 just slightly underperformed the market. So I only got 2 out of 3. But the portfolio generated a full 100 percentage points cumulatively above the S&P 500, and that included 2008, 2009. So I ran the performance from when I gave the interview in 2003 to the date that I did found the study or the interview in 2013. So we know that as professional investors, it's harder to know that as someone who's doing it on your own and doesn't have access maybe to some of the same data. So with that, I'm going to open to questions.
Hello?
Hi.
Can you hear me?
Yes.
Okay. Linda was asking, at what level do you see the market bottoming, and what is the potential reaction to a more aggressive move by Russia?
Great questions. So I think Monday was fairly important, where we had very high volume and we had a bounce off the bottom and stocks ended positive. We were down yesterday, to be sure. We're up today. It'll all depend on what Fed Chair Powell says in the near term. But I think we will end the year in the range in line with earnings. So we've had 3 20+ years in a row, and that's not obviously sustainable. So we think that an exogenous event, which would be the Ukraine and Russia, We'll see this thing bottom at some point. Corporations will come back in and start buying back their shares. This will be after earnings and their dark period ends, and we'll start to see some stability to volatility. I just, you can't, it's hard to predict what's going to happen with Russia and the Ukraine and our response to it. I was on Larry Kudlow's show on Monday, and one of the things that we were going to talk about but didn't was the implications for inflation. And that will therefore have also an additional impact on stocks. Believe it or not, Ukraine is the third largest producer of corn in the world and the fourth largest producer of wheat. Russia's the largest producer of wheat, and they go, they run their trade through the ports that would indeed be potentially blocked. Add to that oil production, and in particularly natural gas. Europe depends on 35% of their natural gas from Russia. The Nord Stream pipeline could be shut off. There's all sorts of things that could happen that would raise energy prices further, particularly in the Eurozone, but would probably have ripple effects through our markets as well. So it's concerning, to be sure. I don't think our response has been particularly strong. There have been a lot of missteps, misstatements, but I think we have to wait and see. The market is clearly not paying attention to that today because I think all eyes are on the Fed. I'm not sure if I answered that, but war, I think we're getting close to a bottom.
Okay. And B Friends wanted to clarify, did I understand correctly that your last chart indicates Apple should be sold now? At what point would you consider rebuying it?
Yeah, this is actually a very hard one. So I have to stick to my discipline because I manage money for institutions that expect me to do so. So we've been net sellers of the stock. Well, first and foremost, it has quadrupled. So we've been net sellers for a long time, but now we're actually starting to reduce our positions. We've gone from 6% of the portfolio down to 2.5% on our way out eventually. And yes, it is in the sell range on both disciplines, on relative dividend yield and relative price to sales ratio. They tend to confirm each other. If you're an individual investor, I might give you a little bit different advice. And that is that you should definitely trim. You should never let the market make your asset allocation decisions for you. And that's exactly what I did. In my IRA, I was grossly overweighted to the stock. It was like 20% of my holdings. So I sold it in my IRA and I diversified, and I held on to it in my taxable accounts because there is dividend growth, even though the yield is low. The stock is acting more like a treasury bond than anything else at the moment. And so it's a flight to safety. And I think it's a company you can continue to hold, like a Johnson and Johnson, or a Starbucks, I guess, or some of the others that Microsoft. But you should own less because the appreciation in your portfolio has probably skewed it. So I would be deliberate in my sales, and I would be thoughtful, not just mindless. The buy discipline is really the most important in my view, because it keeps you from chasing things when they've gone up a lot and you want to get on the momentum bandwagon.
And with the boom in brokerage accounts at Robinhood and other brokerages, with over 20 million new accounts since the pandemic started, can you talk about the risk in the equity markets and the best way to manage that right now?
So there's a couple of answers to that. First and foremost, the bull-bear ratio, and there's a bunch of these that are put together. One is the American Association of Individual Investors, where I've spoken in a number of their chapters. They take a poll every week at their meetings, or monthly. There are also others that show that the bull-bear ratio is at near historic lows. So everybody's pretty pessimistic right now. They might be a little different after today. That's usually a good time to at least consider adding to certain names in your portfolio. But separately, and also the retail investor has been very active this last year. So we don't really want them to get at all disheartened, because retail investor is very important to the markets, and it's important to them to be invested. So I think one of the things we have to keep in mind is what starts in market bear markets, and that is recessions. And what's the leading cause of recession? Fed policy mistakes. So what we'll be keenly listening to is how quickly the Fed is going to taper the balance sheet. I think they've already telegraphed to us what they're going to do with rate hikes. I'll be on Charles Payne today to discuss it. But secondly, what we've done for our clients is a very simple hedging strategy. We buy puts against the SPY and we buy calls against the VIX. And that gives us two levers to pull when stocks get a little squirrely. The options are pretty expensive right now. We just sold some this week in both of those trades because they appreciated so much. But when things settle down, that's always a great way just to provide some protection. You need to be prepared that it's like paying an insurance premium. If you don't need it, you've spent the money and you got nothing for it. But when you need it, it works pretty well. And we had a hedge on going in, we put it on in early February of 2020, and it worked for our clients, kept us clear-eyed when markets sold off so dramatically. But if you buy dividend growers, this last thing I want to say about this is that in an inflationary environment, dividend growers are a great hedge against income inflation, right? Or real income. And they're a hedge, stocks are a hedge against inflation. They always have been. So just because we're in a rising interest rate and inflation market, or have been in a rising inflation market, we think it's going to marginally come down, but not materially. Those have always been great offsets. Stocks have always been the way to hedge that. And if you go back and look at the data beyond one episode, technology stocks have been the best performing sector in a rising interest rate environment. So that is not what you're hearing on financial news networks. You're hearing, in fact, quite the opposite. And that's what we saw this week is people panic selling because they thought interest rates were going to go up potentially, although I'm not convinced that is why people were selling. But nobody knows for sure.
And we actually have quite a few of our investors asking if you have a fund that they can invest in, or if you provide advisory services for retail investors, and how can they find out more information about that?
Yes. So we manage two ETFs that employ these disciplines, but are distributed by someone else. And I think all of this is on our website. We have pretty high minimums for individual management, but we do publish some things that are available to the public. And I'm not, this is not my strength. They don't let me talk about this because I always give out the wrong fee schedule and the wrong minimum account size. I think our minimum, we just lowered it to 1 million, but I'm not sure. So go to the website. It's laffertengler.com.
Perfect. And then we have just a couple more minutes for a few more questions. Is there any strategy to buying a stock during this volatility?
I mean, there's certainly trading strategies. I've used them in the past simply for the information you get during volatility, but periods of volatility. I've been through a lot of these. If you think I've been investing almost 38 years and you get a correction about once every 12 months, we've had 3 bear markets or 4. I don't know what you call 2000 to 2003. And what really works the best is not jumping in, letting things settle. If you have a valuation discipline, like the 2 I've described, you could use low price to earnings ratios. You could use whatever you want, because again, having a discipline is better than having no discipline. But you can have the courage and the conviction to step in at turning points when Wall Street's terrible at calling turning points. Usually what you're seeing is a deluge of downgrades during correction periods. So you can use that. You can look at things like insider buying and selling. I glance at it. I don't pay too much attention. I'm really interested in, if I buy a great company at a reasonable price, that's a winning strategy all day long. Hence our 5-star rating. But you have to be willing to have the courage to step in when everybody's saying the opposite. It's the best I can give you on that. I'm sorry.
No, thank you. And what are good buys right now, and how do you pick what stocks to buy for the long term?
So I talk about some of that in the book for kind of more of a retail focus. I'm not selling the book. it's old, but it might be helpful. But I will say that there's two things that really interest me right now. So we have a labor shortage, and that's got a lot people, wringing their hands. What we've been looking for are companies that produce more revenues per employee. And the two leading sectors, amazingly, are, I mean, you would expect technology to be one, and it is, and energy. And so we've been adding to those names. We've been adding to names in the industrial and material space over the last 6 months. We were preparing our portfolios for slower growth in the spring of last year. What do investors eventually pay up for when growth slows? They pay up for growth. So I'd look for reasonably priced technology companies. So not the growth at any price. I mean, by the way, I'm so tired of hearing people talk down Kathy Wood. She's brilliant. I just don't know how to buy those kinds of stocks. Those are the ones probably to stay away from at the moment. But you'll have opportunities to get back into those stocks after they've bottomed out. I would look for high quality dividend growers in the sectors I just mentioned. Is that it, Aya?
Can you hear me?
And now I can, yeah.
Thank you so much for your time. Unfortunately, we can't get through all the questions, but can you let them know how they can find you if they wanted to reach out and request more information?
An inquiry, I think we have an inquiry section on LafferTengler.com, and that's LAFFER Tengler, my last name, TENGLER.com. We'd love to talk to you.
Perfect. Thank you so much. And we'll see you folks in our next session.
Thanks very much.